Hello everyone. Today, we're diving into a topic that many of you may have heard about but might not fully understand yet: how investing in bonds works. Bonds are a critical part of the investment world, often considered safer than stocks. If you're looking for a reliable way to grow your money with less risk, then this is for you. Let's get started. What is a bond? Think of a bond as a loan. When you buy a bond, you're essentially lending money to a company, a city, or even the federal government. In return, they promise to pay you back the amount you lent, plus interest. This makes bonds a fixed-income investment because you know how much interest you will receive and when you'll get it. Example: imagine your friend needs $1,000 to start a small business. You agree to lend them this money on the condition that they will pay you back in 1 year with an extra $50 as interest. In this case, the $1,000 is like the bond's principal, and the $50 is the interest. Your friend is acting as the issuer of the bond. Why invest in bonds? Many people ask, why would I choose bonds over stocks? Here's why. Bonds are considered safer. When you buy stocks, you own a small part of a company, and if the company fails, you might lose your investment. However, if you hold a bond and the issuer has financial troubles, bondholders are usually paid before stockholders. This makes bonds a good choice for conservative investors or those nearing retirement. Current trends. With rising interest rates in 2023 and 2024, bonds have become increasingly attractive. The Federal Reserve's hikes have pushed bond yields higher, meaning investors can earn more from new bonds today than in the past few years. Call to action. Think about your current investments. Do you have any bonds in your portfolio? If not, consider exploring them as a safer way to earn steady interest. How do bonds pay you? Bonds typically pay interest in two ways: coupon payments and zero-coupon bonds. Coupon bonds. These bonds pay you interest at regular intervals, usually every 6 months. The amount of interest you receive is based on the bond's coupon rate. For example, if you own a bond with a face value of $1,000 and a 5% coupon rate, you'll get $50 per year. Zero-coupon bonds. Unlike coupon bonds, these do not pay interest regularly. Instead, you buy them at a discount and receive the full face value when the bond matures. For example, you might buy a $1,000 bond for $800 and get $1,000 back at maturity. The $200 difference is essentially your interest. Interactive question: which type of bond sounds better to you right now? Regular interest payments or a lump sum at the end? Write down your answer and think about how it fits into your financial goals. Types of bonds you can invest in. There are 3 main types of bonds. Government bonds. Issued by the U.S. Treasury, these are among the safest investments because they're backed by the federal government. Examples include Treasury bonds, T-bonds, Treasury notes, T-notes, and Treasury bills, T-bills. Current news. With concerns over inflation, more people are turning to Treasury inflation-protected securities, TIPS, which adjust their value based on inflation rates. Corporate bonds. These are issued by companies to raise funds. They usually offer higher interest rates than government bonds, but come with more risk because companies can go bankrupt. Apple and Amazon, for example, often issue corporate bonds to fund new projects or expansion. Municipal bonds. Issued by states, cities, or counties, these bonds help finance public projects like roads, schools, and hospitals. One key advantage of municipal bonds is that the interest you earn is often tax-free, making them a popular choice for high-income investors. Actionable tip: look up a company you like or trust. Check if they issue bonds, and compare the interest rates to other savings options. You might find it's a good way to invest in a business you believe in without the volatility of stock prices. When should you invest in bonds? Investing in bonds can be a good idea if you are seeking stability. Bonds are less volatile than stocks, making them a great choice during uncertain economic times. Nearing retirement. If you're close to retirement, bonds can provide a steady stream of income without the risk of losing your savings to a stock market crash. Diversifying your portfolio. Bonds can balance your investments, especially if you already own a lot of stocks. A mix of assets helps reduce overall risk. Key takeaways. Bonds are a safer investment option that provide regular income, making them great for conservative investors and those nearing retirement. There are different types of bonds: government, corporate, and municipal, each with its own set of risks and benefits. Bonds can protect your portfolio from stock market volatility, especially during economic uncertainty or rising interest rate environments. Closing statement. Investing in bonds can be a powerful way to stabilize your financial future. By understanding how they work and choosing the right type of bonds for your needs, you can build a strong, balanced portfolio that stands the test of time. So, whether you're new to investing or looking to diversify, consider adding bonds to your strategy. Thanks for joining this session. Now, take a moment to write down one action step you will take this month to explore bond investing. Let's get started on building a more secure financial future.